Welcome to the marketplace of companies. Imagine a bustling marketplace filled with the sounds of haggling, the vibrant colors of various goods, and the palpable energy of people trading. This is a place where every transaction tells a story, where every item has a value, and where the excitement of buying and selling is in the air. People are buying and selling. There's energy and excitement. Now, picture this same energy, but instead of physical goods, people are trading pieces of companies. This is the stock market, a dynamic and ever-changing environment where fortunes can be made or lost in the blink of an eye. The stock market is like that. It's a place where investors come together to buy and sell shares, which are essentially small pieces of ownership in companies. These shares represent a claim on the company's assets and earnings, but instead of vegetables or clothes, we trade pieces of companies. Each share is a tiny fraction of a company, and owning shares means you have a stake in that company's future. These pieces are called shares. When you buy a share, you are purchasing a small part of the company, making you a shareholder. This means you have a vested interest in the company's success. When you buy a share, you own a tiny part of that company. This ownership can bring you dividends, which are a portion of the company's profits, and the potential for your shares to increase in value over time. It's like becoming a part owner in their success story. As the company grows and prospers, so does your investment. You are essentially betting on the company's future performance. The stock market is where these shares are bought and sold. It's a centralized place where buyers and sellers meet to exchange shares, and where the prices of these shares are determined by supply and demand. Think of it as a giant auction house for company ownership. Just like in an auction, the highest bidder wins, and the price of a share can fluctuate based on how much people are willing to pay for it. Just like in a real marketplace, prices go up and down based on demand. When more people want to buy a share, the price goes up. When more people want to sell, the price goes down. This constant ebb and flow creates a dynamic and exciting environment for investors. Companies need money to grow. They might want to build new factories, hire more people, or expand into new markets. One way they raise this money is by going public. This is called an initial public offering, or IPO. Imagine a company baking delicious cookies. They decide to share their recipe for success with everyone. They offer shares of their company to the public for the first time. This is their IPO. People who believe in their cookies and their future can buy these shares and become part owners. Now, the price of these shares isn't fixed. It changes every second based on supply and demand. If lots of people want to buy shares of our cookie company, high demand, the price goes up. Conversely, if more people want to sell their shares, high supply, the price goes down. It's like any other product or service. The more people want it, the more valuable it becomes. Section 4. Investing, you can do it too. The best part? Anyone can participate in the stock market. Whether you're a student, a working professional, or even retired, the stock market is accessible to everyone. It's not just for the wealthy or the financial experts. With the right knowledge and tools, you can start investing and potentially grow your wealth over time. You don't need to be a Wall Street tycoon. You can start small with just a few dollars and gradually build your portfolio. The key is to be consistent and patient. Over time, even small investments can grow significantly. You can buy shares of companies you believe in and potentially benefit from their growth. Remember our cookie company? Imagine if they start selling cookies worldwide and their profits soar. The value of their shares is likely to go up too. This means your investment could grow along with the company's success. If they start selling cookies worldwide and their profits soar, the value of their shares is likely to go up too. This is the beauty of investing. You get to be a part of a company's journey and share in its success. However, remember that investing always involves risk. The stock market can be unpredictable, and not all investments will yield positive returns. It's crucial to be aware of the risks and to have a strategy in place. It's important to do your research, understand the company you're investing in, and not invest more than you can afford to lose. Diversifying your investments can also help manage risk. By spreading your money across different types of investments, you can protect yourself from significant losses. So, take your time, learn, and start your investment journey wisely. Section 5. Don't put all your eggs in one basket. Diversification. Diversification is a fundamental principle in the world of investing and finance. It's a strategy that can help you manage risk and potentially increase your returns over time. Have you heard the saying, "Don't put all your eggs in one basket"? This age-old advice is not just a cliche, it's a crucial guideline for anyone looking to invest wisely. This is especially true for investing. When you put all your money into a single investment, you're taking on a lot of risks. If that investment fails, you could lose everything. Diversification means spreading your money across different types of investments. This could include stocks, bonds, real estate, and other financial instruments. By doing so, you're not relying on just one type of investment to succeed. It's like having a variety of cookies in your jar instead of just one type. Imagine if you only had chocolate chip cookies and you suddenly didn't like chocolate anymore. You'd be stuck. If one cookie crumbles, you still have others to enjoy. The same concept applies to your investments. If one investment doesn't perform well, others in your diversified portfolio can help cushion the blow. Similarly, if one investment doesn't perform well, others can help balance out your portfolio. This balance is what makes diversification such a powerful tool in managing financial risk. Diversification is key to managing risk and building a strong investment strategy. By spreading your investments across various assets, you can create a more resilient portfolio that can withstand market fluctuations and help you achieve your financial goals.